I'm Shane Simser, Senior Financial Advisor and Business Manager for Morgia Retirement Plan Services. I have 15 years of experience helping people like you understand your company's retirement plan, save into the plan, and preparing for your retirement. Before we get started, let's talk a little bit about Morgia Retirement and who we are. Morgia Retirement is a locally owned wealth management and retirement services firm in Watertown, New York. We manage over 40 401k plans locally. We have a team of 13 team members who are dedicated and focused on helping you reach your retirement goals. This is the start of a series of videos for people like you who are part of your company's retirement plan. I'm going to help you understand your plan, how to use the plan to maximize your savings, and how to prepare for your eventual retirement. We're going to start at the beginning. You've just been hired, you're learning about your new job, meeting your new coworkers, or you've been in your current role for a while and are now eligible to start saving in your company's retirement plan. So what is a 401k? A 401k is an employer-sponsored retirement savings plan where you, the participant, makes pre-tax contributions from your paycheck into an account for investment purposes. Many employers, and possibly yours, will match a percentage of your contributions. They also may share some of the company profits by making what is called a profit-sharing contribution. This is a plan that can provide you with income in retirement when you are no longer working. Why should you join a 401k? There are many reasons to join your 401k. There are tax advantages, the potential to have your employer match your contributions, investing your savings for the ability to have them grow over your working career. And often you are the person that has the most impact in achieving the goal of having financial freedom in retirement. Most advisors, including us at Morgia Retirement, will say that most retirees will need to replace roughly 70 to 80% of their income to retire comfortably. And Social Security is only going to provide approximately 30% of that. Social Security alone often can't provide the income you need in retirement to maintain your current lifestyle. The rest must come from your savings. Now that you've decided to save in the plan, the question we get most often is how much should I contribute? Generally speaking, it's recommended that you start saving 10 to 15% of your income annually and increasing over time until you are saving the maximum allowable amount. Do not feel overwhelmed if you cannot contribute that amount right away. Try to at least start doing enough to get the full match from your employer if they offer one. If they match dollar for dollar up to 4%, start with that amount and then continue to increase it over the years, even if it is as little as 1 to 2% each year. Before you know it, you're saving the 10 to 15% and eventually get to saving the maximum amount allowable. The decision to save an appropriate amount is by far the most important 401k decision you can make, and you just need to get started. Each employer's policy is different with regards to the match. Not all companies match the same amount, so you should check with your employer to see how much they match. No matter what that match is, you should take advantage because that is free money for your retirement, and you can't afford to give up free money. What happens if I wait too long to contribute to my 401k? Maybe you haven't started yet? Is there a disadvantage? What are the advantages to starting early? Starting early combined with compounding can have a significant impact on your account balance. Compounding is growth over a sustained period of time. Over time, your investments can grow and grow. And what makes compounding so important is that not only does your initial investment grow, but that growth is added onto your investment and that larger sum starts to grow. When growth happens on growth, numbers can get large quickly. Let's take a look. Let's take a 25-year-old and a 40-year-old, for instance. Both want to retire at age 65. If they each save $2,000 a year with 6% average growth, we would see a dramatic difference in their account balance at age 65. The 25-year-old would have a balance of roughly $350,000, and the 40-year-old would have a balance of roughly $125,000. That's almost a $225,000 difference, And that is simply due to starting early and the power of compounding over 40 years versus 25 years. Waiting too long to get started could negatively impact your balance and could force you to either work longer or spend less in retirement. Neither one of those things are ideal when planning for your retirement. The 401k has distinct tax advantages. Did you know that you can pay less and save more? Let's take a look. The tax benefits associated with your 401k are the ability to make contributions on a pre-tax basis and your savings to grow tax deferred. Your pre-tax contributions come out of your paycheck before taxes are taken out, therefore lowering your taxable income for the year. Because the government doesn't tax your contributions, you get use of their money for all the years that you save, and the money is in your account. Let's look at an example. Say your paycheck is $1,000 a week, and your tax rate is 30%. $300 a week is sent to Uncle Sam for taxes, leaving you with a take-home pay of $700. Now you decide to save in your employer's retirement plan, and you're going to save $100 a week. Because that $100 contribution comes out of your paycheck pre-tax, you're now only taxed on $900 a week. The same 30% tax rate on $900 is $270 a week in taxes, and you get to use the additional $30 to save and invest in your account. That leaves you with a net take-home pay of $630. It's a change in your net take-home of $70 and not $100. You can use the government's money over a long period of time to save and invest and hopefully grow. Tax-deferred growth of your savings allows you to avoid paying tax on any of the potential growth in your account, and you will not have to pay tax on the funds until you take them out in retirement. Hopefully many years down the road, you'll be in a lower tax bracket in your retirement years, paying the government less tax than you were when you were working. You've decided to save into your plan. You're possibly receiving the employer match, and you understand the tax benefits. Now you must decide how to invest your savings or decide on what investment model or individual investments fit your risk tolerance and time horizon. When deciding on how to invest your savings, you must look at a few things. What is the mix of assets that I should have? We call that asset allocation, the process used to balance your risk versus your reward. You must decide how much to invest in cash, bonds, and stock. And to make that decision correctly, you need to understand the types of risk associated with each asset class. Choosing the right level of risk, or asset allocation, is far more important than the selection of the actual investments. We as advisors will help you determine what is the right asset allocation for you. We'll ask you a series of questions. What is your risk tolerance? How long do you have to save? How long do you have before you retire? Where are you at in your working career? We can help you determine what investment model best suits your needs. Understanding the different risks with each asset class, we look at cash first. Cash is simple and straightforward. It is cash sitting in a money market account. There's not a lot of risk to principal. It's a great vehicle to use to help fund short-term investment goals or short-term purchases. There's not a lot of potential growth with cash. The risk with keeping money in cash is that over long periods of time, it does not help you increase your spending power. If anything, it can decrease your spending power as inflation occurs or rises over the years. Let's look at bonds. Bonds provide a higher rate of return than cash, but you commit your investment for a longer period of time. At the end of the time period, you get your principal back. It's like loaning your money to a corporation or the government for a period of time. They will pay you some interest, and at the end, you'll get your money back. But there are two risks associated with buying bonds or owning bonds. If you need your cash prior to maturity, you may have to sell the investment for less than what you invested. The interest rate that you lock in turns out to be less than actual inflation during the life of the investment, and you lose purchasing power on the money invested. Now let's look at stocks. Think of stocks as direct ownership in companies traded on a public stock exchange. Think of owning stock or shares of companies that you know and you use their products every day. Over long periods of time, the price of a stock will grow at a rate that reflects the company's ability to earn profits. Over a long time frame, you can expect a higher rate of return than cash or bonds. However, there is no guarantee on these returns. Stock markets are not always rational. The risk with stocks is that in a given short period of time, they can lose substantial value. So take your time when deciding on your asset allocation mix and make sure you understand the risks and rewards associated with each asset class. And remember, the most important decision is to start saving.